joined in. Welcome to today's Guru Talks. Today, our guest is Professor Partha Mohanram. We all call him Partha. To the younger people, you should address him as Professor Partha Mohanram. He's the John Watson Chair in Value Investing at the Rotman School of Management, University of Toronto. Prior to joining Rotman, he served on the faculty of Columbia Business School at the Stern School of Business at NYU. Professor Partha Mohanram obtained his PhD in Business Economics from Harvard, MBA from IIM Ahmedabad, where he was a gold medalist for being the best all-round student, and B.Tech in Computer Science from IIT-Madras, class of 1990. He holds designations as an accountant, CPA CGA, and a certified board director. Professor Partha Mohanram has published extensively in many areas of accounting and finance, including fundamental analysis, valuation of growth firms, cost of capital, and corporate governance. He has won numerous research awards. You can just read up his biography in the alumni listing for the event. He serves as the editor-in-chief of Contemporary Accounting Research and on the editorial boards of Accounting Review and Review of Accounting Studies. His research has been covered extensively in the business press, such as the New York Times, Forbes, Business Week, and the Globe and Mail and CBC News. He's appeared numerous times on programs on CNBC, NPR, CBC, CTV, and TVO. So Professor Mohanram is a passionate, award-winning teacher who teaches advanced electives on financial statement analysis, business analysis, and valuation, and other areas in the undergraduate MBA and PhD programs at the University of Toronto. He is also the director of the India Innovation Institute of the University of Toronto, a think tank that focuses on fostering innovation and cooperation between Canada and the Indian subcontinent. Okay, so Sridhar, you wanted a minute, you can just have a minute and then we'll pass it over to Partha to start.
Okay. Thank you, Gopal, for the introduction. I just wanted to add a couple of memories of Partha being my hostel mate. And just wanted to say that he was one of the few guys who was welcoming, open, and was ready to talk to all juniors. And I remember him being very approachable, very easy to get along with, and made us feel welcome in Jamuna. I really appreciate that. It was quite a contrast to other people. And so that is why I remember he was literally a big man on campus. It was almost like, if you remember the 70s NBA uniforms with this, short shorts, that's the image that I have at the moment. But he was quite an all-rounder in Jamuna itself. You can see the award that he got at IIM Ahmedabad, but in Jamuna itself, he was multifaceted, and Partha was quite a memorable guy. We are on 7 level. We are not expecting a Slurpee. We are expecting a lot more from you, Partha, today. So, Tukuda, thank you.
Okay. Sridhar, so nice to see you after such a long time. Even if virtually, I'm sure we'll meet in person. Pleasant memories of the years spent in Jamuna. Gopal, of course, my batchmate and one of the most passionate guys in our batch, very actively involved in alumni events. Thank you for organizing this, and thank you all for coming. I know we're going to have more people joining us. So I'm going to, without further ado, just start by sharing my presentation. Okay, I hope you guys can see this. Okay, so the topic of today's talk is stock picking insights from academic research. So before I start, I know Gopal introduced me, but I'll just hold on. Why is my screen not moving? Yeah, okay. So I'm a professor of accounting at the Rotman School of Management at University of Toronto, and I was at NYU and Columbia before. I got my PhD from Harvard, my MBA from IMA, but obviously I'm extremely proud of my link to IIT-Madras. As you can see, I'm wearing an IITM t-shirt right now, something we got at our 25th reunion, a class of 1990, Jamuna Computer Science. So I do a lot of research in a variety of areas, but today I thought I will focus on one stream of research which has to do with stock valuation, because it's something which is the most approachable and something that everybody can relate to. Couple of points I want to make, both about logistics and assumptions I'm making. I will assume that people know a certain amount of like basic jargon about like earnings and cash flows and valuation and PE ratio and stuff, which I think most people who have invested in the stock markets or read the financial press will know. Okay, but if anything is unclear, please either mention it in the chat or raise your hand and ask a question. I'll try to answer questions, and if I'm unable to because I'm busy with the presentation, Gopal or Sridhar, please prompt the person to ask the question. So I thought what I'll do is we have like just under an hour now. Maybe I have like 3 or 4 topics I want to talk about. At the end of each topic, I'll be happy to take some clarifying questions or whatever. And I'll try to end around 15 minutes before the hour so that you guys ask questions overall. Okay. All right. So basically today's topic is about stock picking insights from academic research. Okay. So what is stock picking? Stock picking is deciding which stocks to buy, which stocks to hold, which stocks to sell. And if you have the ability to do so, which stocks to short sell. Short sell essentially means that you sell a share that you don't even have in the expectation that the price will fall and you'll make money on the how good your sales are, how good your growth prospects are, therefore what you should be worth versus what you are worth. And that's what is called fundamental analysis. Fundamental analysis is very different from technical analysis. Technical analysis looks at the pattern of stock prices and looks for things like support lines and so on and so forth, and says that based on momentum and like reversal or whatever, the stock is going to go up or go down. They're very different. They both, in a sense, assume that markets are inefficient, because in fundamental analysis, the assumption is that there's some information which the market has not correctly impounded into prices, and you're trying to kind of get one step ahead of the market. Technical analysis is even more of an extreme assumption, where it's saying the market is so inefficient that it can't even look at the pattern of prices and adjust. So that's the one major difference. The other difference you can do is you can look at it stock picking from a very small sample approach, where you say, okay, I'm going to look at universe of, I'm going to look at like these 10 stocks, and I'm going to go in depth in each of these 10 stocks and figure out which are the ones which are worth buying, which are the ones worth selling, and so on and so forth. Or the other approach is you can do a large sample quantitative approach, where you have data on like 5,000 stocks or whatever the case might be, and you have some overall financial metrics, and based on some ratios or some parameters, you decide that these are the good stocks and these are the bad stocks. Okay, and in fact, that's the approach I'm going to be focusing on, and I've done in my research quite a bit. However, all approaches have some common features or common threads. Okay, which is one, they're trying to identify which stock is overvalued and which stock is undervalued. That's the first commonality. But the second commonality, which is more important, is there is a belief that this misvaluation is going to be corrected. Okay, and so you'll make money on the correction. So suppose there is a stock which is worth 50, which you think should be worth 100, based on your calculations and stuff. You're taking a bet that, I'm going to buy it at 50. I know something, market doesn't know it right now, but the market will know this. And when they know it, the stock price will go up to 100. And therefore, I will make money when that happens, right? But what if the market either doesn't ever know it or doesn't believe whatever you are, have in your mind or your analysis? Then the stock will never go to 100 and you'll never make money. Okay, I give my students an analogy where, let's say you are you're investing in stock, or investing in, let's say, materials, and you're your chemistry, and you suddenly come to realize that, I have carbon, and carbon can come in two forms. It can come in many forms, but let's say it can come in coal or it can come in diamond. And coal is like, you can get like kilograms of coal for a few rupees, and diamond is like thousands of dollars for just like a half carat diamond or whatever. So you can say this is like a market misvaluation. So I'm just going to buy a whole bunch of coal, and I'm going to short diamonds, and I'm going to wait for the market to correct itself. Well, that correction is never going to happen, because society has decided that diamonds are worth more than coal. And if you have any doubts about it, try giving your significant other coal instead of diamond for an engagement ring. It's not going to work, right? So the correction of misvaluation is extremely important. So the question I'm trying to ask in this presentation is, can academic research guide us in stock picking? Okay. So I'm going to cover the following topics, and I'll probably spend around 10 minutes on each of them. No, probably a little less on the third topic because it flows into the fourth one. The first one is general. It doesn't pertain to my research in particular. The second one and the fourth one are very specific to the research I've been doing. And so essentially the first topic is the role of earnings versus cash flows in valuation. Okay. The second topic is about how you can use information and financial statements for value investing and growth investing. And I'll talk about what these are as well. I'll also talk about the use of formal valuation for stock picking, and finally, how you can combine this financial statement approach with formal valuation approach. Now, all of this research is based on data analysis using US data, but generally speaking, the implications are pretty universal. It is acknowledged that the US capital markets are the deepest and generally considered the most efficient. And so if you find an inefficiency in the US market, its odds are that the inefficiency will exist at a greater extent in other markets, although trying to make money of that inefficiency might be more difficult because of difficulties in trading and so on. Okay. So the first topic is earnings versus cash flows. Now, what do I mean by earnings and cash flows? I just want to make sure that everybody understands. By earnings, I'm referring to net income. If you look at a company's financial statements, there are three financial statements. You have the balance sheet, okay, where you have the assets and the liabilities. Okay. Then you have the income statement. The income statement essentially is the one where you'll see revenues and expenses and all that stuff. And the bottom line is net income. Now, this net income essentially uses a lot of assumptions, like, a lot of accounting assumptions. So, for example, you might sell on credit and you haven't got the cash for it, but you can still call it revenue. You may have some expenses which you have to estimate. So things like depreciation and so on and so forth. So what ends up happening is this net income or earnings are very different from cash flows. Cash flows is the amount of cash your business actually generates in a given year. So there's a third statement called the cash flow statement. Okay, cash flow statement, which will have three parts, something called the cash from operations, cash from investing, and cash from financing. So cash from operations is like a cash measure of performance. Net income is this accounting measure of performance. So there's a lot of discussion in research about which is more important for valuation. And so I'm going to talk a little bit about this. And this is based on some research done by a couple of people, Dichow and Sloan, who are both senior professors currently at the University of Southern California. So if you think about this earnings versus cash flow debate, which is more important, and you will hear lots of conflicting views on this. So there are many people, especially those with a strong finance emphasis, will say that I don't care about earnings. Cash flows are what matter. Why? Cash flows are real. Cash is something, you can't pay bills with earnings because earnings are an accounting assumption, but cash is real. And in the long run, the firm needs cash to survive. Also, earnings can be easily manipulated. So if you've been following the recent news in India about Adani and Hindenburg, one of the accusations is Adani is like manipulating its financial statements and its earnings are like fictitious or whatever the case might be. Similarly, people made similar accusations which turned out to be correct about companies like Enron. Okay, so cash flows has this advantage of some sort of tangibility, but earnings also have some advantages. The first is investors focus on earnings. Nobody talks about price to cash flows ratio. Everybody talks about price to earnings ratio. Okay, of course, this might be a self-fulfilling prophecy, so it may not necessarily be correct, but that's what investors focus on. But earnings in general is a better measure of value added. So if you've made a sale, if an airline has, if you've made a sale, calling it a revenue is okay as long as you're reasonably sure the customer is going to pay. And if the customer is not going to pay, this with some probability, you take care of it in the accounting as well by taking an allowance for like bad debts or something like that. So earnings tends to create a better measure of actual value added in a given period. Cash flows, on the other hand, tend to be quite volatile. earnings is less volatile, which means that earnings are probably a better measure of performance. And so generally speaking, if you have things like compensation or even like stock market and all, the metric people use is earnings. People use stock returns, of course, but earnings is the accounting or the financial statement people use. But so it's an empirical question of which of these two should be more important in terms of stock market returns. Okay, so this is the question that this person called Dichau, she tried to answer in her paper. So she did some analysis and she found that this is a non-issue. It's actually a slam dunk. Earnings have a much stronger correlation with returns compared to cash flows. So essentially, this accounting process, which leads to the generation of this thing called accruals, all these accounting decisions you've got to make, like calling something sales even though you haven't got cash for it, calling something an expense even though you actually don't spend cash on it, things like depreciation and stuff. All these things do add value. Even though they could be manipulated, on average, they add value, which leads to earnings being a better measure of the performance. And you can see that in the markets. Markets focus on earnings. Markets focus on earnings per share and cash flow per share. Nobody talks about the PE. Everybody talks about the PE ratio. Nobody talks about a PC ratio. Now, at the end of each of my slides, whenever I'm referring to a paper, I'll also give a link to the actual paper. So those of you who want to read the paper can download it from Google Scholar or wherever. And I'll also email a copy of my slides to the folks at IITM. So if anybody wants a slide, please ask them, or you can email me and I'll be happy to share it with you as well. Okay. Now, this might lead you to conclude that, okay, earnings matters, cash flow doesn't matter. But that's also not correct. So basically, Dichau's work might lead you to believe that earnings are more important than cash flows. But Sloan, who had a paper a couple of years later, looked at this thing called the accrual anomaly. So the accrual anomaly essentially is you have two measures of performance. You have net income and you have cash flows. And the two of them can be different. Like some years net income can be high and cash flow can be low. Some years cash flow can be high and net income can be low. He looked at the difference between net income and cash flows, and so that he can compare it by across companies, he divided by assets. So you can compare large companies and small companies. And then he looked at firms which have high and low accruals. Okay. And he said, you know what, let's look at the stock returns for these companies. And what he found consistently was these high accrual firms earned negative returns, while these low accrual firms earned positive returns. And basically what he identified is this thing called the accrual anomaly. And the reason for that is these accruals have a tendency of reversing. So if your income is extremely high and your cash flows are low, your income is high because of some accounting decisions you've made, which has boosted income. Now, that may have happened in this year, but odds are those things will reverse in the following year. Conversely, if your cash flows are high and your net income is low, you've probably made some accounting decisions which have depressed income. And odds are those things will also reverse in the following year. You'll have a boost in net income. So what he basically identified was that the market doesn't necessarily understand this and therefore is consistently negatively surprised by these high accrual firms and positively surprised by these low accrual firms. So he said, let's invest in this in a strategy, what is called a hedge strategy. I'm going to invest in these guys. I'm going to go long in these low accrual firms, and I'm going to go short in these high accrual firms. And how does this strategy do? So basically what he shows, and you'll see it in the next graph, is across the time period he studies, with the exception of 1 year, consistently this strategy earns positive returns. Okay, so what this means essentially is that what he's shown is that accruals have a tendency of reversing, but the market doesn't understand it. So it thought those high net income firms which had low cash flows will continue to have high net income the following year, but they don't. Conversely, those low net income firms which had high cash flows have high net income the following year, so the market is positively surprised. So the takeaway is that earned cash flows do matter. Earnings and cash flows are two different measures of performance, but you have to look at them together. So if you look at a lot of people who do like equity analysis, they focus a lot on this thing called earnings quality, right? So essentially, earnings quality is, if you don't want a firm whose earnings are high simply because of accounting assumptions. You want a firm whose earnings are high because the fundamentals are good. So this is basically what this Sloan's paper shows. Okay. Now, whenever you have a strategy or an approach which shows a lot of returns, the first question to ask is, are you really showing something which is genuine? Is this truly you've heard people using this term alpha, right? Alpha is this term for excess returns. But the second Greek letter you should also pay attention is beta. Beta is this term for risk. So when you show a lot of returns, everybody claims it's alpha, but in reality, it could well be beta. Okay. So that's something you need to focus your attention on. So a lot of research, firstly, when this result came about, right, many people were quite surprised because you think about beating the stock market, everybody thinks, you need to hire these PhDs in physics and quantum physics. So these guys will be solving like fifth order differential equations to get some excess returns. And here comes this guy who says, just take earnings, subtract cash flows, divided by assets and sort. There's nothing high tech about it. You can do this in middle school. So it's a real sort of damning threat to the notion of efficient markets. So there was a lot of resistance and people said, no, this has to be risk. But a lot of papers looked at it and the risk-based explanations didn't really pan out. So the general conclusion is maybe the markets are more inefficient than we think they are. So the other interesting fact is Sloan wrote this paper in 1996, and this effect continued till the year around 2000. After 2000, this effect has weakened considerably. Now, why has this effect weakened? That has also been the focus of a lot of research. So there has been one set of papers which say that the reason why the effect is weakened is because people know about it now and everybody's investing in it. And that's the way markets work. Markets are adaptively efficient. That is, they may not be perfectly efficient, but once somebody tells you that there's an opportunity here, the arbitrageurs will rush in and the efficiency will weaken or go away. Okay, that's one explanation. Second explanation is the accounting for financial statements has improved. So people have improved their accounting, and as a result, many of these accounting manipulations people use to boost earnings and all are less possible, and that's the reason this effect has weakened. Now, the third explanation is something I've worked on a paper, which is analysts, the kind of people who give equity reports for people, used to focus exclusively on earnings. But now they focus on earnings and cash flows. And if you focus on both earnings and cash flows, in a sense, people have to look at both of them and they're less likely to get fooled. So I'm just showing you a graph from this paper. It's not proof necessarily. The graph in blue is the returns to this accruals anomaly. As you guys can see, till the year 2000, the returns are pretty solid. They're always positive. They're like 5 to 10% every year. Okay. Remember, this is 5 to 10% returns on zero investment. That is, you're going long on $100 and short on $100 on the one group, and you're still earning money because one group does better than the other. As you can see, from 2000, this effect has weakened considerably. But the graph in red is the proportion of analysts who are issuing cash flow forecasts. So as the proportion of analysts who issue cash flow forecasts increases, I show that the accrual anomaly weakens. Okay, so that's my first topic. And now the second topic, and the one I want to spend most of my time on, is this thing called the fundamental analysis for value and growth stocks. And this is based on the research by Piotrowski in 2000 and my own paper in the year 2005. But let me take, I'm like 20 minutes or 15 minutes in. So I'll just stop my presentation for a second and see if there are any questions or comments anybody has.
Partha, in business school in late 90s, my finance professors were claiming that the free cash flow was the only thing that you should really look at and not earnings, and just for all the varieties of things that you were talking about. Is that still an important measure in corporates now, or has that also kind of?
No, absolutely, and it's certainly one of the most dominant measures people still use. People use free cash flows and stuff to value companies. But the calculation of free cash flows also is not something which, this is also something where understanding the accounting issues are important. I'll give you one simple example. People use free cash flows, but people are unsure about what to do with things like stock compensation. So if you look at most tech companies, the biggest expense is stock compensation, right? And so many people exclude stock compensation when calculating free cash flow, saying it's not really a cash expense. Now, this is a very, very myopic view, because stock compensation, while it's not a cash expense explicitly, it's implicitly a cash expense, because either you're diluting the existing shareholders, or many of these companies repurchase shares in the future to reduce the dilution. So there is outflow of cash. So what I show in a more recent paper is that in the calculation of free cash flows, if you exclude stock-based compensation, you will systematically overvalue companies, and analysts are doing this. So, but in general, right, there is so I'm a professor of accounting. Okay, so I have a very strong financial statement emphasis, and I do valuation. I've noticed, and I'm not dissing finance professors, but finance professors view accounting as a black box and say that, you know what, I don't care about the accounting, just give me the numbers. The problem is you need to understand how those numbers are created. If you don't understand how the numbers are created, it becomes a case of garbage in and garbage out. So you can do all the finance techniques you want to, but understanding how those numbers came into being is absolutely essential. Okay. All right. So let me just continue my presentation now. And I'm going to move to my next topic, which is fundamental analysis for value and growth stocks. So now, very briefly, let me just tell you what value and growth stocks are. Hold on, my screen is a little stuck. Yeah, okay. Value stocks and growth stocks are essentially based on their valuation. Value stocks are those which have a lower valuation. Usually people use ratios like the price to earnings ratio or the price to book ratio to decide if something is a value stock or a growth stock. So if your valuation ratios are low, you're called a value stock because relative to your fundamentals, you have a lower price. On the other hand, if your valuation ratios are high, you're referred to as a growth stock. So in general, historically at least, value stocks have done better. So for example, value investor like Warren Buffett has made lots of money, not necessarily by buying the Nvidias and the Teslas of the world, but by buying Burlington Northern and Geico and all these very humdrum stocks which have low valuations but very solid fundamentals. Okay, so as opposed to growth stocks, while there have been some tremendous successes, there have also been some massive failures. So if you think about the tech stock meltdown of the late 1990s or so on, right? However, so generally the way this effect is, people look at this ratio called the price to book ratio, and they find that these high PB stocks, they generally earn negative returns, and these generally earn, negative returns. These low PB stocks generally earn positive returns. Okay, and this is because of the fact that you're already buying very high valuation. So odds are you're buying on the hype, and therefore the stocks do badly. Here, on the other hand, you're buying firms which are undervalued, and therefore the stocks do well. Okay. Now, however, this effect is not uniform. A lot of value firms perform poorly, and on the other hand, there are some growth stocks which become the next Google, the next Apple, the next Tesla, the next Nvidia, whatever the case might be. Okay. So essentially, the interesting question to ask is, do markets incorporate all the information and financial statements in the evaluation of these companies? So Piotrowski in 2000 looked at these value firms. So these value firms, like I said, these are the firms which have low ratios. So they have a low price to book and the low PE ratios. And he said, okay, in the subset of stocks, also one thing he noticed was these stocks generally tend to be the ones which have less analyst following and less institutional investment and stuff. So they have less media attention also. So these firms are ignored. So his logic was, if these firms are ignored, odds are there's information in the financial statements which the market is not considering when trying to value these firms. So can we come up with some way of creating an index of strength or weakness and see if this works to identify which stocks to buy and which stocks to sell? So he basically did, I'm sure those of you who've done some sort of financial statement analysis or ratio analysis have probably heard of this thing called the DuPont framework. Essentially, you look at a firm, you look at its profitability, you look at its ROE, you look at its return on equity, you look at something called the asset turnover, You look at its profit margin and all this stuff. And you want firms whose ratios are either good or improving. So either high ratios or ratios which are getting better. So what this Piotrowski does is he does this sort of basic fundamental analysis. He does it in a stock screening mechanism. He essentially asks, it's like asking 9 yes or no questions. Are you profitable? Is your profitability increasing? Is your asset turnover increasing? Is your profit margin increasing? Yes or no? And based on that, he creates his index called the F score, which can be 0 all the way to 9 based on how you do on these questions. And then he says, you know what, these high F score firms are the ones I think are fundamentally strong. Low F score firms are the ones I think are fundamentally weak. So if the market has not looked at these financial statements, if the market has looked at the financial statements, the price should already reflect the value. But if the market has not or done it incompletely, I think these firms will do well, while these firms will do poorly in the future. So I'm going to go long in these firms, and I'm going to go short in these firms. And let's see how this strategy does. So basically, Piotrowski's strategy, he shows, does incredibly well, at least up to the point of his paper, which is 1997. His paper was published in 2000. So he shows pretty strong returns. And essentially, he shows that fundamental analysis is of great significance in value stocks. And so he identifies diamonds in the rough. What do I mean by that? I call it rough because these have low valuations, but there are some firms here which deserve high valuations. So he says, you know what, of this group, this is the one you should try to identify, or you should try to buy. So firms which might have temporarily low valuation or whatever, they may have weak fundamentals, but they're getting fundamentally stronger. Now, his approach, at least historically, will work well on the long side. What do I mean by that? Let's say this is the market as a whole. Okay. And I told you that historically, value firms overperform the market. Growth firms underperform the market. What Piotrowski is telling you is these are good value firms and these are bad value firms. He's saying buy these guys and short these guys. But given that the value firms are already doing better than the market, you don't need to short. You can just go long. You can just say, I'm just going to buy them and I'll beat the market by this much. On the other hand, with growth investing, which I'll talk about next, you're underperforming the market. So even if I tell you that these are good growth firms and these are bad growth firms, if you invest in a good growth firm, you're just going to be sort of doing as well as the market. To really get a benefit from this growth investing, which I'll talk about next, you need to short. Okay, I'll talk about that next. But basically, this Piotrowski's paper very much intrigued me because my first question was, why is he not looking at growth stocks? Maybe fundamental analysis doesn't apply to growth stocks. Maybe growth stocks are valued on something else, like sentiment or some non-financial indicators or whatever. But I'm also a big believer that in the long run, fundamentals matter. Okay, even a company like Tesla or Nvidia or whatever, right? Eventually, these guys will have to deliver. And if they don't deliver, their valuations will come down. Tesla was a $1 trillion valuation company. Now it's like a $500 billion valuation company. And if their fundamentals don't improve, their valuation will decline. Okay, so I came up with this modified fundamental analysis score called G-score, where I took the Piotrowski approach, but I modified it for the context of growth stocks. Now, I'm not going to get too technical, but I'll talk about two aspects of the strategy which are different. The first thing is I focused on this idea called naive extrapolation by looking not just at the ratios, but in the variability of the ratios. Okay, I looked at two ratios, return on assets, which is a profitability measure, and growth, like sales growth or whatever. And I looked at the variability of the measures. Let's say you have two firms. You have firm A and you have firm B, both of which have very high valuation. Okay, and both of which have high current earnings and growth. Okay, but firm A, its earnings and growth are stable. Firm B, its earnings and growth are variable. I argue you should invest in firm A because my argument is that the high growth and high earnings of this firm A is something which is to be expected to persist. Firm B maybe just got lucky, and these guys will see reversals. There will be some variability. Next year, the earnings and growth will not be very good. So this is the firm you should invest in. This is the firm you should not invest in. Okay, that's the first thing I did. Second thing is I looked a little bit more into the accounting. So if you look at these firms, these market to book firms, or these firms that have a high price to book ratio, as I called it, right? I said, is there something going on in the accounting which is depressing their fundamentals? The thing is, for many of these growth firms, right, they invest a lot in things like R&D and advertising and so on. And the accounting system forces you to recognize these as expenses. So many of these firms, many of the largest assets are not even on their balance sheets. So the balance sheets tend to get understated. So I said, let's try to identify which ones have the most amount of missing assets, because then odds are they have these high valuation ratios, not because they're overvalued, but because their accounting is undervaluing their book value. So I also included these kind of factors, and I created this index called the G score. Now, if you look at the, similar to the Piotrowski strategy, I said, I'll invest in the high G score firms. I'll go short in the low G score firms. Very, very similar approach I find for growth investing. So essentially, I show that a quote unquote fundamentals based value investing approach can also be used in growth stocks. Now, obviously, what I'm doing is a little different. Okay. So if you looked at my example for Piotrowski, I said he separates diamonds from the diamonds in the rough. Okay. Because these firms have poor valuations. Now, the problem is for growth stocks, these firms already have diamond valuations. What I'm doing is I'm separating out the real diamonds from the fake. So which are the ones which deserve these high valuations and which ones don't? Okay. So firms which have a solid, sustainable growth and so on. Now, as I mentioned earlier, if growth stocks as a whole underperform the market, you need to essentially short for the strategy to be successful. But as my next few slides will show you, the things have changed in the last 15 or 16 years. So there is this website called Validia, okay, which tracks portfolios of gurus or whatever you call them. I'm very happy to note that they've listed me as one of the so-called gurus or whatever. In fact, this strategy is the second best performing strategy of all the portfolios that they look at in the last 15 years or whatever. So this is a little different from the papers because this is one particular website implementing it their way, but based on the fundamentals in the paper. It's also long only, so they're not shorting. They're only looking at the buy recommendations on this thing. Okay, so it turns out in the last 15 years, the value investing has not done as well. The last 5-6 years especially has been incredible for growth stocks. But what is interesting is even for growth stocks, not all growth stocks do well. So having some kind of a fundamental analysis approach to investing in growth stocks is also useful. So just to give you a sense of how these have done, and this information is from this Validia website. As you guys can see, the dark blue is the line is the performance of the strategy. The light blue is the performance of the market as a whole. So Piotrowski did pretty well, but in the last few years, value investing has not done well. So they've underperformed the market by around 80% over a 20-year horizon. So the market has returned like 350%, 370%, and they've returned 290%. It's not bad, but they've underperformed the market. But here is my strategy, right? So the period is different because the paper was just written at a different point of time. But while the markets earned around 300%, the strategy has earned around 1250%. Okay. And all of this is public domain, by the way. So this is not something that it's not a proprietary strategy or something. And I personally, to be completely honest, I have not invested using my strategy, at least not at any scale or something. So unfortunately, I haven't made any of these 1250% returns myself or whatever. Although, I'm not exactly complaining or anything. Okay. So that is the second topic I wanted to talk about. Now, again, like I said, I'm going to move to the third topic, which is slightly different, but yet related. So I'll just again take a 2-minute break for questions before I move on. So if anybody has any questions, please feel free to.
Couple of questions for you on the chat box. You're able to read them?
Yeah, let me get to the chat box. Okay. Okay, first question. I have no idea how to identify penny stocks. I'm not trying to identify penny stocks. So that's not a that's not something that I can actually do. Okay. Second question is, how can a naive investor make use of extensive research to make investment? Front end online exist where investors actually they do. So these kinds of things are becoming quite common. Like, so for example, even this Validia is a subscription service that you can get, and very often there are people. There's like a lot of people who do this like, you know, free. And so for example, there are people who are calculating this F score and G score for companies, and you can actually get this information. And I believe this stuff is certainly available for the US markets, and it will be available, I'm pretty sure. And finally, these things are really, really simple. It's something that an ordinary investor can do. There's not extensive research. All you need to do is look at some financial statements and make some. I mean, you'll find it difficult to do this for 4,000 companies, but let's say you're interested in company A or company B, you can very easily go and compute these things. It's not different. Sridhar, you have a question?
Yeah, I was just an observation. I mean, let's say if I were Piotrowski and I found the strategy has worked really well, or I found you found your strategy worked well. Why publish the paper? Why not invest in the market with that strategy?
Yeah, to be honest, like I had no idea my strategy was going to work this well. Okay, so that's the first thing. So maybe I made a bad choice in 2005. Right, that's the first thing. But the second thing is, I mean, that's what we do as academics, right? So this is what we do. We publish our work, and there's a lot of people who don't. There are, like, for example, you've heard of this company called LSV Associates. You know, it's like one of the largest hedge funds in the world. It's got like $300 billion of assets under management. It was started by these three people, Lakonishok, Schleifer, and Vishny. Lakonishok was a professor of finance. Schleifer is one of the top economists of the world at Harvard. Vishny is one of the top financial economists of the world at Chicago. The three of them started this hedge fund, and Lakonishok left academics and he runs a hedge fund, right? And the question is, money is not something which motivates everybody the same way. So like in my case, I could have easily made like, you know, 10x of what I do if I was in the private sector. But, you know, I'm very happy with what I do. And I think academics pays me well. And I do occasionally do some consulting assignments and stuff. So it's not like I'm exactly hurting on things. So that's my answer.
There's one more question. Rudra Joshi has asked a question.
Okay, so all of these are, my strategies are all long horizon strategies, right? These are all strategies which are buy and hold for 1 year. So this is not a intraday thing, because fundamentals don't get updated in the intraday thing, right? So that's much more of a technical analysis, or like, you know, moving on like very, very fine information or volume and all those kinds of things. So it's totally unrelated. So this is buy and hold horizon of at least a year. Horizon can be shorter, because so if you look at this Validia, for example, you go to the website, these guys have a what they call monthly rebalancing, where they have a portfolio of like 10 or 15 stocks based on that strategy, and every month they rebalance, because some firm again can get its new fundamentals, and that they can go higher or lower or whatever. The last question is, yes, absolutely. If more people, everybody implements it, this will go. But this is not, however, this like the accrual anomaly, right? Accrual anomaly is not is so basic, right? That it and there were so many other factors in play that it kind of weakened. This strategy, in fact, as you guys can see, it is like it's become even stronger. And the reason it's become stronger in the last few years is simply because growth investing has just gone completely through the roof. And as growth investing has gone through the roof, and there are many reasons for that. The market's become a winner take all market, and you've seen the growing importance of these intangible assets and all, like, so all these tech companies and all. But what my results show, that even in that space, there's a value for doing this kind of fundamental analysis. Okay, so I'm going to move on to my last two topics, which are closely related. Okay, so let's go here. Okay, so this F score and G score, which I just talked about, are financial statement based approaches, right? So these are all approaches where we are looking at financial statements, trying to find firms which will do well, firms which will do badly or whatever. But we don't look at valuation per se. I don't look at what the current the current stock price has not entered my calculus at all, right? I'm just assuming that the market has these indicators of quality and they are not impounding it, and therefore I'm going to make money on that. An alternative approach, which is also used by many fundamental people in fundamental analysis or doing this kind of investing, is they estimate the value of the stock using a variety of different approaches. So they look at the future earnings and project them out and say that I expect the stock price based on this and discount rate, whatever. I think the stock should be worth 100, it's worth 50, and therefore I want to buy the stock. So they compare their estimate of value to price to understand which stocks to buy and sell. These approaches are fundamentally different, right? The F-score and G-score is trying to identify good stocks versus bad stocks. This intrinsic value is trying to identify cheap stocks versus expensive stocks. And the two may or may not be the same, the approaches. So the next thing to ask is, firstly, how would an approach which uses this fundamental analysis sort of formal valuation work? So there is a paper by this gentleman called people called Frankel and Lee, who use this model called the abnormal earnings valuation model, and they essentially estimate V, which is the value of the stock, and they compare V to P, which is the price of the stock. And if the V to P is high, it means this is a stock whose value is high relative to price, and this is a stock you need to buy. On the other hand, if your V to P is low, this is a stock that you need to sell or you need to short. So essentially, that's what they do in their paper. And I'm not going to spend time on the paper, but essentially they show that this V2P approach is extremely successful in identifying undervalued and overvalued stocks. Now, the natural question asks is, how are these things related to what we just talked about, this F-score and G-score approach and stuff? Are they the same? Which is better? And if they're not the same, does it make sense to combine the two? So that's what I look at in my next paper, which I'm cited below here. Fundamental analysis, combining the search for quality with the search for value. Search for quality is what this F-score and G-score do, right? They try to look for good quality and bad quality stocks, but they are not looking at the valuation of the stocks per se. So in this paper, I have two measures of what I call quality, okay, F-score and G-score, which we've discussed. And I have these two measures of what I call value or cheapness or whatever you call it. One of them is this V2P ratio I'm talking about. The second is this ratio that people use called the PEG ratio. Okay, the PEG ratio essentially is they take the firm's PE ratio, which is the price to earnings ratio, which is the measure of valuation. High PE means you got a high valuation, and they compare it to the firm's expected growth. So essentially, what this is telling you is it's okay to have a high PE ratio if you have high growth, because that's the reason why I'm giving you high ratio. But if you have a high PE ratio and your growth is not that high, that's not a good stock. So generally, high PEG is a bad thing, means you're overvalued. On the other hand, a low PEG means you're undervalued. So because of it's an inverse measure, I use a negative of that, and I call this neg PEG in this ratio because I wanted measures of value. The first table here is a correlation table, which tells you how these measures correlate to each other. And as you guys can see, F-score and G-score have a positive correlation. By the way, the correlations matrix are different on the above and below the diagonal because there are two ways of measuring correlation, Pearson and Spearman, but ignore that. Okay, so F-score and G-score, as you guys can see, are positively correlated with each other because they're both measures of quality, slightly different, but both measures of quality. But F-score and G-score are negatively correlated to these measures of value. That means that these two strategies are actually working against each other. And I'll show you that in a second. So here is an example. Okay, I'm looking at firms sorted on the basis of this F-score. So as you can see, mechanically, F-score increases from the first to the fifth quintile, 5 groups. Across these quintiles, G-score also increases. Not the same extent because the correlation is not perfect. So generally high F-score firms tend to be high G-score firms as well. However, the V2P ratio tends to decline. So remember, V2P is a measure of value. So essentially these stocks are a little more expensive and these stocks are in general cheap. Or as you guys can see, the PEG ratio is also higher here because remember this is a negative of the PEG ratio. Right? So basically, this is an expensive stock in general, right? What is this telling you? This tells you that in general, quality comes at a price. If you want to buy a BMW, you have to pay a BMW price. If you want to buy a Hyundai, you pay a Hyundai price. That's just the way the world is. That's telling you on average. Okay. So firstly, if you look at these individual strategies, they all work. So this is like the returns to quintiles. That is the bottom and top group. As you guys can see, F score generates returns. So 6.7%, G score generates 5.2, VP generates 6.4, NECPEG, this generates 5.7. So they all generate returns. But what happens if you combine these strategies together? So what I'm saying here is, I want to invest in F score firms, but among the high F score firms, I want the firms which have high VP as well. Similarly, I want to short the low F score firms, but among these, I want to short the ones which have the low VP. Because I think these will be the best of the best, and this will be the worst of the worst. That's my approach. Okay. And that's what I do in the next table. And as you guys can see, I'm looking at the same F score quintiles, but then I'm breaking them up into the VP quintile. So as you guys can see, the returns increase across each group. So essentially, what I will do is I will invest in this group, the high F score, high VP group, and I will short the low F score, low VP group. And you guys can see that 6% return becomes a 15% return. And the same thing is true when you combine F score with PEG. You can combine G score with VP, G score with PEG. I find this result is true for all four combinations. Okay. Now, obviously, the details are in that paper, which are cited there. But fundamentally, what it says, these two models are inherently different. Looking for quality and looking for cheapness are two different goals, right? However, when you combine these two goals, you get the best of both worlds. I call this the TJ Maxx approach. So those of you who live, or Winners is a Canadian equivalent, right? TJ Maxx is this place where you go. What is TJ Maxx? You get high quality brands sometimes if you look around, okay? But you get them at a good price. Or you go outlet shopping, okay? That's another example. Essentially, you want the quality, but you don't want to pay too much for it. So essentially, this is the takeaway, that you should try to combine both an emphasis on buying a high quality stock. So you want to go long on the stock which has the highest F score. So it's like this deal you can land in TJ Maxx. And you want to go short on the fully priced poor quality stock. So something which is, outrageously overpriced thing in Neiman Marcus. That's the kind of stock you want to short. Okay. So that is essentially the takeaway from this paper. So just to conclude, right, and I will leave around 7-8 minutes at the end for questions. Stock picking is it's kind of educated guesswork. I don't really want to call it an art. Also, it's not a science, certainly. Okay, practitioners, because it's not something you can parameterize and say it's surely going to work. Practitioners will use a variety of different approaches and signals, financial information, in-depth knowledge of industry, and so on and so forth. Hopefully, the kinds of things I've discussed will help you decide on which kind of firms you can invest in, you can stay away from, you can sell, or if you have the ability to and willingness to, you can short. Okay, so I will end there, and I'll be happy to answer any questions that you guys might have. We have around 7-8 minutes left.
Any questions? Please just ask Partha. Partha's finished his talk. You can just unmute yourself and then.
Yeah, please, just unmute yourself and ask me any question. I'll be happy to take. I'm also looking at the chat to see if there are any more questions, but there don't seem to be any. And if anybody wants any of these papers, like I Gopal, I don't know, I'll email you a PDF version of my presentation.
Yeah, we can just put it, hyperlink it to the event page where your event is listed, and they can download it from there perhaps. Or I can check with IITMAA if they have any other way of
Yes,
circulating.
yes, sir. I will send the thank you mailer with the YouTube link. There I can attach this PDF file.
Okay.
So
Okay.
you can just mail it to
Also,
them.
okay. So Gopal, you have a question, right? About do stockbrokers misuse such education?
2 minutes.
I don't think anybody is misusing anything. This is public domain information, right? So if as Sridhar had asked me,
Just a
if Sridhar had,
request to
yeah, I
request to please mute yourself. I think there's some disturbance in the background.
yeah.
Please allow Partha to just continue this talk. Yes.
So
I think
I
somebody
don't.
is unmuted and there's some disturbance in the background. Please just
Yeah. I'm
cooperate
just
and mute
looking
yourself.
to.
Yes.
Yeah, please.
Yeah, you can continue.
Yeah. Okay. So like I said, there's no misusing of this information. This information is in the public domain, and anybody who decides to act on it and make returns is also taking a risk, right? Because what if I was wrong? So if I was wrong, then I mean, I'll say, hey, it's just my paper, so it's people are putting their own money, and if you put your money and you make money on it, it's fine. And this is a public domain thing, so it's perfectly it's fair game, so. But there are a lot of people do this. I mean, many professors, like this Ashwath Damodaran in NYU, he runs a website where he puts his stuff out. It's all there for people to see, because all of us rely on the knowledge that we gain from people who came before us, and so it's our job to kind of provide knowledge for people who come after us. So, yeah. Okay, so I think I don't think there are any more questions. So I'll hand the floor back to Gopal and Sridhar.
Question from Sriram.
That's funny. That's one question is there. I'm guessing most algos factor these academic interactive phenomenon, so these analyses are very confusing and different. I don't think so. Like I said, most of the algos and all these guys tend to certainly they do. By the way, there is like I said, there is a paper which looked at how returns to these so-called anomalies decline after papers are published, and they found that it does. But this, I don't think this is an anomaly per se. This is just an approach towards fundamental analysis, right? And like I said, there are many implementations. Firstly, there are paid services you can subscribe to, which is not very expensive, which gives you this access to these kinds of things. But this is not very difficult to actually do. And even like I said, you don't have to do this like strictly the way I do it. This is just ways for people to think about when they are deciding which stocks to look at. The last question, is it market agnostic? I think it is. In fact, there have been people who have looked at these studies and looked at them in different markets, and they found that the returns are much higher in other markets. Doesn't mean you can get those returns, especially on the short side. Or you may not be able to actually get those high returns for two reasons at scale. There might be the issue of price impact. Like, if everybody goes and buys a stock, if one person goes and buys a little bit of a stock is undervalued, the price won't move. But if you buy it in large quantities, the price will move. So that could be a factor. So, but people have shown that it does work pretty strongly across the world. And strategies like accruals and stuff are still effective in other markets because they probably haven't been arbitraged away. So. Okay. All right. I think I'm out of time.
We can take one or two questions more if anybody wants to ask. So this is your last chance. Please just unmute yourself and then ask your questions. We'll just wait for a couple of minutes. Otherwise, we'll close the session.
Yeah, I have another question on DM on somebody asking me how effective is momentum-based investing strategy. I don't know. It's not something I'm considering. Like I said, my strategy is not momentum-based. It's not looking at previous track returns. People have analyzed that. And in fact, the latest pharma fringe factor models include momentum as a factor as well. But like I said, that's not something I look at. So I can't answer that question.
Okay, I think that.
Okay, last question.
Okay,
Have any
this-
major funds started using these methods? I'm guessing they have, because I do see people talk about this, but they haven't sent any check my way, to go back to Sridhar's question. So they do it, they just do it. And like I said, they might do it explicitly or implicitly, right? So which is fine. So
Okay, I think we can just conclude the session. IITMAA, would you like to just propose a word of thanks?
Yeah, Partha, thank you. Very informative, and thank you, Gopal, for reaching out. He's been doing a stellar job at reaching out and organizing these talks. Really, these are people that he knows, and that's how other people get to know about your research and so on. Finance-based topics have especially worked well with IIT-MAA alumni. They're all very interested to find out how to make money, I guess. So this has been well received. I really thank you for the time, Partha. And when you come to Chennai, please do. First of all, keep in touch. And when you come to Chennai, just place a visit at the Alumni Association offices. I'd be happy to entertain you for a little while.
yeah, actually, thank you for that. Actually, there's a small chance. I mean, I'll try to. I'll be making an India trip end of this month, so maybe in August I'll try to see if I can figure out some time. Anyway, along with this Professor Venkatesh Mannar here, I'm part of the Canadian IITM sort of philanthropic arm, so I have to come to IITM for that. So I'll try to figure out some logistics.
Any chance you're going to be in India till mid-September?
No. I got to go back in mid-August because I have teaching and my semester
Uh,
starts.
we've got a big conference coming up called Sangam, which is like a all India alumni IIT-Madras alumni conference. So
Okay.
I'd love to have you there, but if you're not staying back,
If you have a session, if you want me to be part of a session and do it on Zoom or something, I'd be happy to. If that logistics work,
okay, we'll definitely consider. Thank you, sir.
Okay, great. Vinod, can I close the session? Will the recording get automatically updated in YouTube?
Yes.
Yes, sir.
Okay. Okay. So thank you very much, Partha. Thank you on behalf of all the alumni, the Alumni Association. It was a very, very informative talk. And I'm sure Partha's line of work would have set the trend, and for some of the younger alumni who have joined in and who want to, work on research problems in this area. And that's the way to go. And thank you very much. It's been very informative. Thanks for talking to the alum. Thanks on the alumni.
Thank you. Thank you, Gopal.
Thank you.
Take care.